The U.S. earnings season begins this week, setting the tone for markets already driven by risk on sentiment. This comes despite the U.S. and Iran talks collapsing in Pakistan and President Trump blocking the Strait of Hormuz. It seems that investors are still hopeful that talks between the two sides and the temporary ceasefire could still ease tensions between the two sides, or at least prevent major disruptions in global shipping. Against this backdrop, we are going to look at pound dollar, the US 500 index, and Bitcoin against the US dollar. So let's have a look at the charts and see what the technical signals suggest. Then starting first with pound dollar, well, the pair will also face some local data releases. UK GDP growth figures for the month of February will be out later this week. Probably the data may not include the impact of the Middle East crisis and therefore could cause a limited reaction in markets. Nevertheless, any significant surprises could still affect rate expectations, and futures markets are still pricing in a 25 basis point rate hike in the coming meetings. So it will be quite interesting to see if it's going to be more repricing there. Also, global central bankers and financial ministers will be meeting in Washington later this week, and any comments from Bank of England's policymakers could also affect the British pound, which is currently trading near a critical resistance territory, basically the one that blocked upside movements back in February and also in January. And as we can all see, there is a key resistance trend line, the one that connects the highs from July 2025 and September 2025, also being in the same region between 1.3540 and 1.3550. That area also overlaps with the 38.2% Fibonacci retracement level of this up leg over here. So it will be obviously closely watched as the technical indicators over here are approaching, particularly the RSI and the stochastic oscillator are already very close to overbought levels. So a key move here probably will be a decisive close above this region, in which case the rally could extend significantly towards the 1.3665 and perhaps towards the 1.37 psychological mark, where the 23.6% Fibonacci level is also placed. Now on the downside, in the event that downside pressures return, and perhaps if policymakers decide to play down rate hike expectations, then the price may pull below the 1.35 territory in order to retest the 1.35 number, where the 50 and 200-day moving averages are located. We can see that the price is currently actually achieved a nice bounce above this line, so any pullback below this territory could dampen market sentiment and perhaps confirm additional losses towards the 1.33 and 1.3340 territory, where the 61.8% Fibonacci mark, as well as the 20-day moving average and the upper boundary of this broken bearish channel are placed. Now, if we look at the US 500 index, this had a very nice V-shaped recovery phase since the end of March. We have almost recovered the downfall from January, from the all-time high of 7,013. We are very close. We are actually in short distance below this, the all-time highs. Nevertheless, we can see that there is still a key resistance trend line currently limiting upside movements near the 6,900 level. This comes ahead of the earnings season, which starts this week. US banks will be reporting later today, and Netflix will be also closely watched on Thursday. So investors are waiting to see whether the US corporate world will keep posting upbeat results. Forecasts suggest a double-digit growth for the S&P 500 companies, and historically, over the past decade, companies have been beating market expectations. So a similar episode could still support Wall Street. Nevertheless, what investors would like to hear is whether is what's the outlook for the coming quarters given the cloudy geopolitical outlook, the constraints in the Strait of Hormuz, as well as the risk of higher inflation and higher oil prices. So obviously, outlook will play a key role in driving this rally. And if companies sound more optimistic than analysts think, we could even approach the 6,980 territory. That's the 161.8% Fibonacci extension of this downfall over here. So we have to surpass this in order to move towards the 7,000 number and even higher, perhaps up to the 7,100 territory where this key resistance line is located. Now, on the downside, and particularly if we look at the technical indicators, we can see that those are already very close to overbought levels, so we cannot rule out downside movements. Perhaps a close below 6,875 could drive us back to the 50-day moving average near 6,750. Then below that, the 220-day moving averages could also provide support between 6,625 and 6,680. Failure to hold here would actually worsen the short-term outlook, would put confidence back to this downfall, likely driving us back to the 6,500 territory. Nevertheless, we can also see that the MACD is rising within the positive territory for the first time since January, so that suggests that the short-term risk is still skewed to the upside, but of course a confirmation above 16,900 is needed. And now looking at Bitcoin against the US dollar, well, Bitcoin has been also quite resilient. It has been following US indices higher. It's almost 10% up, similar to the rise in the US 500 index, currently testing the key obstacle near 74,750. That coincides with a 38.2% Fibonacci retracement level of the downfall that started in January. Looking at the technical indicators, we can see that there are some signs of improvement. The MACD is also within the bullish territory, the RSI sloping upwards, but the stochastic oscillator is already weakening near its 87 overbought level. So we cannot rule out downside movements here either, particularly following the recent recovery. Nevertheless, we can see that what's more interesting is that the price is finally above this resistance trend line coming from October 2025. We are currently trading above this line, and we are waiting for another decisive close higher for a second green candlestick to become more confident that this recovery phase could extend towards the 79,000 level. Then beyond that, all the attention will turn to the next barrier, seen near 84,300. Now, in the event of a pullback, I would like to see a clear close back below this resistance trend line, currently seen near 72,175. If that happens, then I will next target the 20 and 50-day moving averages near 69,280, while below that, the next pivot point could be found near 66,740. That coincides with the lower band of this gradual upward sloping channel, and if the price fails to hold here, if it closes lower, then and particularly below the 65,000 number, then perhaps a steeper decline could emerge back towards the 60,000 number. So the risk is still skewed to the upside, but since we are trading near key resistance levels in both three markets, keep a close eye on your trading orders and keep a close eye on the upcoming earnings season, UK GDP growth figures, as well as comments from policymakers. More volatility could emerge later this week as geopolitical tensions remain elevated. So that's everything I wanted to share with you guys. I hope you liked my analysis. We'll be back soon with more technical updates. Thank you for watching and wish you a great trading day.